Good morning. Welcome to the January 6, 2020 Teachers Retirement Investment Meeting. I'll start by calling the roll. John Adler.
Here.
Thomas Brown.
Here.
Natalie Green-Giles.
Here.
David Gazansky.
Present.
Russell Buckley.
Here.
Deborah Penny.
Here.
Susanna Vickers.
Here.
We have a quorum. I'll turn it over to Deborah Penny, our chair.
Yeah. Good morning. Thank you. We'll start with the passport funds. Robin's here. Robin,
Good
you
morning.
want Michael?
Thank you.
Good morning, everyone. Happy New Year. So we'll start off the year talking about November, which you might recall was a pretty strong month across the board for markets, both in the U.S. and abroad. The Russell 3000 index for the month was up almost 4% at about 3.8. And abroad, we saw really strong returns there as well, with the EFI index up about 1.1% and emerging markets up. Actually, emerging markets roughly flat to slightly negative for the month. But in general, it was a good month for the passport funds. The diversified equity fund in November, with assets of about $16 billion, were up about 3.1%. What drove the absolute returns for the fund during that month? Again, really strong U.S. markets, with the active composite up about 3.5%, though slightly lagging the Russell 3. The defensive composite up about 2.25%, and the international component up about 1.3%. That brought the year-to-date return for the fund, calendar year-to-date return for the fund, to about 24%. So really big numbers. Huge, some might say. If you look at the Russell 3000, Russell 3000 through November was up 27%, and with the strong month we saw in December, up over 31% for the calendar year 2019. The balanced fund also had a positive month, up just shy of 1%, about 0.75%. The year-to-date return for that fund was positive 9.5%. The international equity fund up 1.25% for the month of November, calendar year to date up just shy of 18%. The inflation protection fund did have a negative month in November, down about 0.6%. Year to date, that fund is up over 8.5%. And the sustainable equity fund up 3.9% for the month of November. Calendar year to date, that fund was up 21.1%. If there's no questions on November, again, I already hinted at December, but I can spend a little bit more time on December. So I already commented on the U.S., again, up about almost 3% during the month of December. For the fourth quarter alone, up about 9% in the U.S. So again, really strong numbers for 2019. The calendar year return for the Russell 3 was 31%. The defensive composite, again, with a beta of below 0.7, around 0.7 or so, that part of the program was up about 25% for 2019. And you can see the diversified equity funds hybrid benchmark also up about 3% for December, with a calendar year return of about 28.6%. The balanced fund benchmark up over 1% during December, calendar year to date return of about 11.4%. And then when we look abroad, you can see developed markets up over 3% during December, with a calendar year return of about 22%. Small cap a little bit better there, a little bit better for both of the proxies we're showing here. For the month of December, up nearly 5%, and calendar year to date up over 22-23%. The emerging markets, they had a really strong fourth quarter last year. In December alone, the emerging market benchmark was up about 7.5%, and calendar year up 19%, with the international composite benchmark up nearly 3.5% for December, and a calendar year return of 22%. You can see below that the underlying strategy for the inflation protection fund also had a strong month during December, up nearly 2%. Calendar year to date, we'd expect that fund to be up about 10.5%. And below that, the underlying strategy for the Sustainable Equity Fund. Again, that strategy was incepted back in October within this fund, but you can see up 2.5% for December. And for that fund, which doesn't necessarily reflect the entirety of the history that was in the Sustainable Fund, but you can see the Sustainable Fund composite benchmark, which is the linked history there, up over 33% for the calendar year to date. So I'll pause there, but obviously we've talked about what was a really strong period for 2019 alone was a strong period for equity markets. We're starting to see a little bit more volatility for many reasons as we move into the new year. But obviously, when we look at what markets have done, all of that again is part of the discussion we've been having about strategic asset allocation and thinking through about how much market performance over the last 10 years factors into our view over the next 10 years. So see if there's no questions.
Can you do this again next year?
We'll try our best.
We'd like to take responsibility for 2019, not so sure about 2020. But
We can do it in hindsight.
Yes,
You can either
absolutely.
disavow or
So you're going to be ready for a discussion of our asset allocation?
sure.
Robin, you're going to discuss?
Sure. So this is in the context of a continuing discussion, given the importance of this topic, as well as the complexity of the questions we're trying to address. We wanted to continue the dialogue. We've been continuing it behind the scenes with the Bureau of Asset Management, and Micah Dodd, who's certainly been part of leading these discussions, is here. And so we are prepared to address some of the issues that have been raised, but given the holidays and the timing of this particular meeting, we're certainly not prepared to address every question. However, we brought along Matt Malari, who I think you've met before. He works with Joe Nankoff as part of our asset allocation team and was a partner at Rokaton and is now very engaged in asset allocation and capital market research in the combined Rokaton-Goldman entity. So I'm going to ask Matt to take you through the deck that was distributed in advance of this meeting. But again, I want to highlight the fact that what we're trying to address is one central question that was raised at the last investment meeting, which was, what would happen if we modified the U.S. equity return expectation that was part of our analysis that had been previously presented to the board. Our U.S. equity assumption, in terms of returns particularly, over the next 10 years, is significantly lower than that of the other consultants who serve the New York City retirement system. And so that's an important question that we wanted to address, and so we went back and we said, what if we just isolated this one factor, and we also adjusted real estate, which has less significant implications. But what if we had isolated this return expectation for U.S. equities and ran a similar analysis? What would be the result of that? And I think that's a really important topic for discussion and consideration, because the board needs to evaluate all of the recommendations, but the most important and most significant change that's being proposed is a change to the U.S. equity allocation. And that also, and our U.S. equity assumption also has implications for our private equity markets assumption and for other assumptions, other asset classes that are linked to equity markets. So that's the context of what we'd like to bring to the board's attention and use as the basis for discussion today. Any other thoughts before Matt launches in? Anything you'd like him to highlight as he goes through this deck? Nope. Okay, well, we'll certainly have time for discussion.
Sure. Great. Good morning. Happy New Year. Good to see everyone again. I think Robin sort of laid out the high-level context for why we did this. I won't rehash much of that, but I will just put a few numbers around what Robin outlined, and also just provide a bit more background on the methodology for how we arrived at what we're about to look at. So as Robin said, our U.S. equity assumption for the next decade is much lower than that of what the other consultant systems look like, consultant providers look like. Just for context, our U.S. equity return assumption for the next 10 years is 3.5%. That's an annualized number, so 3.5% a year for the next 10 years. The average of the other consultants, of the other providers, is about 6.5, 6.4 to be exact. And so what we did is we made adjustments to our methodology to get back to that 6.4% expected return for 10 years.
Can I just stop you 1 second?
Sure.
I really is a question for Dan. 6.4, that seems high. Like as I looked at it, was 6.0 for the.
I didn't bring my spreadsheet with me. I just looked at my backpack for it. It's the arithmetic average of the other four, so it's excluding Logan.
But I don't actually. So I don't have single markup on this board. But Wilshire's 6, NEPC is 6, Callan is 7. So I guess.
Okay. And it's important to know that number excludes Rogan.
Okay, I got it. All right.
And it's arithmetic and not weighted by the system, so fire and police get the same weight in that average than a nicer or whatever.
And I think probably important to point out that if it was 6 versus 6.4, we probably wouldn't come to two different results. So I don't want us to get kind of too stuck on the 6 versus 6.4.
No problem. Thanks.
One other thing just to point out, Robin alluded to this earlier, but rather than just changing U.S. equity, which is certainly at the center of the conversation, but we know if we adjust our U.S. equity assumption, we have to be fair and as we go through this, we have to think about what other asset classes are influenced. Should we have a more improved outlook for U.S. equity markets? Robin again alluded to this, but the ones that we'll look at this in just a moment. But private equity obviously has a heavy component of U.S. equity valuation, embedded into it. The same is true of convertibles. So another asset class that's heavily linked to the U.S. equity market. And then Robin also mentioned this earlier, but we also adjusted our real estate assumption. There's reasons we can get into, but essentially what we did is we brought our real estate assumption back to what Rokutan would consider its standard assumption. What we were using previously was a bit more inflated, and there's probably some back history that we could rehash, but I think the point is that when you look at the numbers, the real estate numbers look more like Rokutan's sort of typical real estate assumption. So with that, maybe it's helpful just to look at page 3 and actually look at what the numbers were. And again, this is the impact on the assumptions. This doesn't. We'll get into a moment. What does this actually mean when you're building portfolios, when you're thinking about allocations to different asset classes? But these are just the numbers on paper. We've hopefully made it pretty easy here to again highlight the asset classes that changed. So you see that U.S. equity in the top row there, the 3.5, which is, again, the Rokutan called standard or original assumption, and then modifying that to 6.4% for the next 10 years. So up about 3% over the 10-year period. And you can follow that through down to all the asset classes shaded in green. So private equity, you can see the impact there, and then convertibles as well further down at the bottom of the page. And I mentioned already real estate, which also has a corresponding impact for private infrastructure and real assets. But you can see that coming down about 1%, again, more in line with the Rokutan called standard assumption for those asset classes. So any questions on how we got here or how we ended up with these assumptions? Okay. All right, so if you flip ahead with me to page 4, this is kind of the high level. We have numbers behind these. These are a series of efficient frontiers. And what we did is there's 4 sets of frontiers. It'll become clear in a moment kind of which is which, but we ran efficient frontiers using those 10-year assumptions that you just saw on the prior page, and then the 30-year assumptions that were also on the prior page. And what we did, again, if you flip back at the prior page, there were an original set of assumptions and then what we're calling adjusted. So 4 sets of assumptions which are on the prior page. We have 4 sets of efficient frontiers which are on here on page 4. It should hopefully hopefully the obvious, but if you look at, given that we now have higher return expectations for U.S. equity, private equity, real estate being a little bit of an outlier with a lower assumption, but the frontiers for all the adjusted, so you see 10 years constrained adjusted, which is that sort of yellow gold line there, much higher than the 10-year constrained original frontier. And then the same is true for the 30-year frontier as well, where, again, naturally, if you have higher expected returns for certain asset classes, your efficient frontier should look much higher than it otherwise would.
So can I jump in?
Yeah, sure.
So I would focus on the 10-year curves because that's where the really significant impact can be seen. And so what you would be doing then is comparing the two bottom curves, the blue curve, which is based on the assumptions we developed at Rokaton, and then the gold are the assumptions that are more closely aligned with the other consultants' equity assumptions. And not only are the returns higher at every level of risk, but importantly, the yellow line with the adjusted assumptions has a much greater slope to it, which tells you that you're getting paid for taking incremental risk. So at the heart of Rokaton's assumptions is the belief that taking on incremental risk over the next 5, 7, 10 years will yield less incremental return. And that's really the heart of the argument. And risk in your portfolio and in virtually every institutional portfolio is dominated by U.S. equities. Even if they're not the majority of capital, they're the majority of risk because they're a relatively risky asset class and they influence so many other asset classes. And so that's the debate that's going on, not what number is correct, because none of these numbers are absolutely correct. But the real question is, do we believe we'll get paid for taking incremental risk, particularly in U.S. equities, over the next 10 years? Yes.
When you put your revised projections together using the other consultants' numbers, did you just basically look at their numbers and say, okay, and just throw them in? Or did you dig into the weeds a bit, or were you able to dig into the weeds a bit to find out the rationale behind those assumptions and whether or not they're reasonable in your mind?
Do you want to respond to
Yeah,
that?
we didn't have that level of granularity. We simply backed in. So we kept the same Rokaton framework, process engine model, whatever you want to call it, and just backed into getting to that 6.4% number. So we didn't try to figure out how do they get from today to 6.4. We just said, okay, if we had to get to that number and using the Rokaton engine, here's how we would do it.
So but that raises an interesting question. Why do they believe that number is correct? And we don't have that.
And we have kind of the...
That's exactly, just to follow up on what David asked. So my assumption is that when you're presenting this, I'm not hearing that you're 100% convinced that the revised assumption, that I'm not hearing that you're changing your original model and you're just showing us what it would look like if we adopted everybody else.
That's exactly right.
Yeah, we have a couple additional slides which we'll cover, which basically say, what do you need to believe to get to 6.4? We don't believe in it, but if you wanted to say, I think 6.4 is reasonable, okay, let's look a little deeper and what do you have to believe to get there, so we can cover that in a moment. I think that'll be quite helpful.
In terms of providing context to the other consultants thinking, I don't know if Mike or Alex have any thoughts that they want to share if you've been engaging with the other consultants.
No, I don't think we have dug in deeply into the building blocks. We respect the independence of each of the consultants in the process, and it's, I don't think BAM weighs in on challenging the building blocks, so to speak. We kind of take them as it's their expertise. They have the economics group, the modeling group, resources that we don't have.
And just going back to the numbers that John raised previously, it seemed that there was sort of more similarities between all of the other consultants, and Rogaton was kind of
An
an
outlier,
outlier
yes.
in terms of your assumptions.
That's exactly right.
But you're not moving towards the mean, you're staying.
No, we have a process that led us to these numbers, and there's nothing about the other, there's nothing about what we're doing that leads us to believe that our process is erroneous, but I think because we are an outlier, it should be discussed, and the most important decision the board will make is what should be the equity allocation within this portfolio. So it just deserves a lot of time and discussion. Okay.
So maybe let's jump ahead to page 5, and you can actually see what do the tangible numbers look like. And there's a lot of columns here on page 5, so we'll try to step through each of these carefully. But the first, we have all the asset classes in the far left-hand column. Under the title there, original assumptions, we have not only the current policy target, but this initial recommended policy target. So this is all under the framework of that original set of assumptions, the 3.5% U.S. equity return, and you can see there where we've landed. So again, focus on, I think there's a few line items to focus on, but obviously U.S. equity being the one that's really at the center of this conversation. So 29% today, policy target down to 22.5%. And then you can see kind of the change across all the other asset classes. Investment grade fixed income, probably the corresponding offset there, going from 17% today to 25%. There's obviously some minor differences in some of the underlying sub-asset classes, but if you were going to kind of hone in on where the biggest changes, it would be that U.S. equity line item and then the investment grade fixed income line item.
I'm sorry, Matt, I don't see the change in U.S. equity.
So 29% there under the policy target, showing going to 22.5%.
Right, but was that the...
These are all under the original set of assumptions.
So
Right,
you've seen all these numbers.
Right, but it's exactly the same for the adjusted.
Yeah,
so there's no change.
What we're showing there, so that's the same target. The one you want to focus there on the far right is that next 10-year optimization.
So let me just, because I had a little bit of trouble with this page. So the numbers that the first two columns, original assumptions, you've seen this state already. Right. None of this changed. Right. So then what we did is we said for the next three columns, Matt walked me through this previously, the next three columns, what we did is we said, what if we adjusted the return assumptions for the policy targets? So you can see that we have an expected compound return of the current policy of 5.2% over the next 5 years. If you under the original assumptions, and that rises to 6.5%.
That's where the change.
That's where the change is. Then, if you look in the middle column under adjusted assumptions, it says initial policy targets. These are the same allocations that we had originally recommended, but you see the returns rise because we've raised the U.S. equity assumption. Then, if you look at the final column, the next 10-year optimization, this says, what would the model have come up with as an optimized portfolio at the using the adjusted return assumptions? And you can see that for 10 years we kept it at approximately the same level of return of the current policy target for the next 10 years and a slightly lower risk level. So what we're trying to say is what would the current policy look like, what would our original assumption look like, and what would an optimization look like based on the adjusted U.S. equity returns.
The optimization is almost the same, 28.5 versus 29% as
yes.
current policy.
Yes, which says if you raise U.S. equity return expectations, no surprise, you won't end up reducing U.S. equity significantly. Right? So I think that's intuitive. Is that, Susanna? You look doubtful.
It's not intuitive to me, but I can. I mean, the raising, yes, that makes sense. But basically, nothing is changing. If our current policy, maybe Susan, if our current policy target is 29%, currently, before this exercise,
yes.
Then basically what the optimizer is saying is to stay about the same.
If you believe that your return is going to be north of 6%.
If Rogaton believed what the other four consultants believed, you wouldn't really move. You're exactly right.
Okay.
But that's if they, yeah.
The model says you're not going to
won't
do
do
anything.
anything.
You're in a good place. So what we're saying is this assumption is the heart of the decision.
Okay, got it.
What else is worth noting on this slide, Matt?
The other thing, worth noting is just if, forget about U.S. equities for a second, but what about at the total portfolio level? So if you go to those rows down at the bottom as far as expected return and risk across the different time periods there, 5, 10, and 30 years. So if we think you can get, 6.2% over 10 years, those again using our current assumptions on the policy target, what if we adjust that U.S. equity assumption? What would your expectation be? It would be about 100 basis points higher at 7.1. So just again, trying to isolate if we did have a higher U.S. equity return assumption, how might the conversation change? And then as Robin just walked through, how might the allocations differ? So it's trying to really isolate both factors is, again, what allocations might you want, but also what might your return expectations be? And again, the influence is clearly on the shorter term 5 and 10 year type numbers, where if you look at the 30-year numbers, whether you use our old set of assumptions or these revised, adjusted set of assumptions, the return expectations look pretty similar.
So it might be worthwhile to hand out material that we sent you on Friday, so we presume you haven't had much of a chance to look at it, which provides some data about U.S. equity market return expectations.
Well, let's have that. One quick question on your adjusted assumptions on the next 10 year. Did you use all the same constraints that were used on the original? So basket clause, min-maxes, all the same.
We did, yeah. Yep, there was one or two kind of tweaks here and there, but mostly related to private assets, but by and large the same constraints. So I know people are still getting the handout. There's a couple pages here. The first page is I'll say it's related, but I think the other pages 2 through 4, I guess really 2 through 5, cover some of what I think some of the questions that folks had about, okay, how do you get to 6.4, and if you're going to believe in 6.4 versus 3.5, what do you have to do to get there? So if you have the handout and you're on page 2, this is a hopefully pretty simplistic type chart, but I think hopefully puts in context where would you end up if you got 6.5 or 6.4 for the next decade versus where would you end up if you got 3.5% for the next decade. So what we're showing here, the left-hand side of this chart, that dark blue line there is the actual S&P 500 index level. So what have we achieved, or what has the index looked like over the last, call it 3 decades? You can see obviously the 08 period stands out, and then the kind of post-08 through this year, the kind of rapid rise we've had. We're estimating the S&P 500 was up about 340% cumulatively over that time period, over the last, call it, decade plus. But what if so starting from today, starting from January 1st, 2020, if you tacked on 6.4% a year for the next decade as the kind of average consultant expectation is, versus the Rokaton expectation of 3.5, what would it look like? And what we're showing here, to be fair, is kind of a straight line. We know there's likely volatility along the way, but I think hopefully puts in context that if you were to get 6.5 a year for the next 10 years, you'd be up about another 90% cumulatively. You can see that's the orange dotted line there, obviously the one that's a bit higher. And then, what would you expect if you were to get the Rokaton 3.5% for the next decade? That's up about 40% cumulatively over the next 10 years. So again, we know it's not a straight line, but I think trying to give you a sense that 6.5 a year for 10 years, it almost doubles the index from today's levels. And don't forget, we've come off a return of about 340% over the last 10 years. So I think it just tries to put it in context. What's on the next few pages, pages 3 just has some background. Pages 4 and 5 are probably the ones that are sort of a little bit better to look at. But without getting sort of too granular here, I think it's helpful to say, okay, if I thought 6.4 was reasonable for 10 years, how do I get there? And really, in our mind, there's 2 ways you get more return from U.S. equities. One is that valuations, so equity market multiples, price-earnings ratios, continue to go higher. That's one way that we know equity markets can go up. Or the other way, and there's lots of ways for equities to do better, but one of the other ways is we get actual earnings growth, right? So you get compensated for companies growing earnings. So we've tried to isolate those 2 factors and say to ourselves, if you were going to rely on valuations to go up, or you were going to rely on earnings to be spectacular over the next 10 years to get back to this 6.4% return, what would that look like? So maybe just put some numbers and some visuals around it. So page 4 has, again, S&P, all S&P 500 here, to just keep it simple. Valuations for the equity market. So we use the Shiller-Cape methodology, so PE ratios, again, using the Shiller methodology, which tries to smooth out for earnings. Today, the equity market, using that metric, is trading at about 30 times. And you can see the history there and what happened in 2008, as well as, I think, importantly, what it looked like back in sort of the late 90s, early 2000s, the tech bubble. You can see it climbed up over 40 to close to 45. But again, what happens if we play it out? So if we want to get 6.4% a year for the next 10 years, and all we're going to rely on is valuations, so forget about earnings. We're going to keep earnings where they are today in real terms. We just want valuations to get us there. Well, that PE, that multiple, would have to rise to about 36 over the next decade. So certainly not nosebleed territory, not going back to the late 90s, 2000s, but at a level that you can see we think is above normal. And you can see we put there what we think the rope time equilibrium. That's what our kind of fair value is. That's what we think is reasonable for the S&P 500. So again, not heroic by any stretch of the imagination, but again, you're talking about you need equity market multiples to rise for a decade, essentially. So that's one part of it. I think the other part of it is the earnings story is maybe a bit more powerful, which is on slide 5 there. So again, similar concept. If we thought we were going to get 6.5 on U.S. equities for 10 years, and the only way we were going to get there was through earnings, so actual, real, tangible earnings from companies, forget about valuations, we're going to keep those where they are today, we would have to generate about 3% real earnings. So that's not, add that to inflation, so you're talking about 5.5% nominal earnings growth. And let's just use the 3% number because I think it's a little bit easier to focus on. 3% real earnings. It doesn't sound that outrageous, but what we typically think of when companies grow earnings, it's typically linked to how well the economy is growing. Not always. There can be periods where the economy does better or worse than companies can grow earnings, but by and large, for companies to grow earnings, the economy needs to do well. And so what we're saying is, again, sort of making a few assumptions here, that the economy has to grow at 3% a year for a decade. We haven't achieved 3% real growth, real GDP growth for much of the last decade. But in order to get back to that 6.5%, you have to assume we get 3% real growth for the next decade. So those are the bookends, right? So we can either get 3% growth for 10 years, or we can get valuations to go from where they are at 30 up to 36. And there's obviously endless combinations in between. But that's what you have to believe. That's what you have to subscribe to believe that we can get 6.5% for the next 10 years as far as the U.S. equity return. So again, they're not heroic, but they're you have to have some strong belief in those 2 set of assumptions.
Just in terms of those assumptions, if you overlay on the blue line the experience of the S&P 500.
Which page are you on?
Either of these.
Either one.
Yeah.
Okay.
4 or 5. I'm just curious as to over the past period if these assumptions sort of held true. So if you put a line that was the S&P, would it match the way it would have been expected?
Yeah, very, very tightly. Again, some of the cases are obvious, right? 2008, the correction there, and whether you're talking about earnings or valuations, looks quite similar. The rise we've had over the last decade looks quite similar. That as far as valuations look, the longer your time horizon, the more likely it will look like the S&P 500. So what we've done, we've done this chart before. We show what valuations look like and what do the S&P 500 look like, and they almost sit on top of each other. So over short periods of time, yes, there are definitely divergences, and earnings and valuations can look a lot different than your experience as an investor. But if you stretch that out over 5 or 10 years, what earnings do and what valuations do will look a lot like what the S&P 500 does.
And you may recall this chart, which we didn't include here, which is my favorite chart, which is this like histogram. It shows what the next 10 years looks like when the starting point is higher or lower PE ratios. And there's this very linear relationship. The higher the PE ratio is at the start of the time frame, the lower the next 10 years return is, which makes sense. There's a cyclicality, there is some reasonable level of valuation, and when you earn 30% in 1 year, and you've earned an average of 13% over 10 years, one would expect there's going to be some adjustment because those returns are higher than anyone thinks the U.S. equity market can generate over a long period of time.
Dave and Deb, did you have a question?
Yeah, so I just want to get it straight because this whole thing kind of feels awkward. So it's your belief and what you think is going to happen versus the other consultants.
Well,
I mean, that's what we're
so
comparing.
what we're trying to do is get it away from, ideology or
Right, and just-
beliefs. What we're trying to say to the board is that the way we came up with different assumptions is that we think that U.S. equity market has done very well, has done much better than anyone expected, and is fairly highly priced in terms of PE, and that our return assumption primarily rests on this understanding that to assume even a 6% return over the next 10 years requires us to believe that PE valuations will go significantly higher over the next decade, and that there is a higher level of earnings growth than we think the economy will support. So we're not going to fall on our swords for the 3.5% because that's just a reflection of our estimate of the richness of the U.S. equity market. But we are saying that 6% seems to us to be a fairly heroic number, even though that's the consensus.
And is there like a middle ground? Like,
Yeah, there are endless. So that's a great question because the point I think that it's most important to get across here is that we initially recommended a reduction of something like 6.5% in U.S. equity allocations, and the Bureau of Asset Management is supportive of a reduction of some level, of some degree in the U.S. equity allocation. I think the most important fact is that we think we think we should take some of the risk that we have in U.S. equity markets off the table within the policy target. If you said 6.5% seems outsized, we'd like to be more mainstream, and you said we want to do 4%, there is no magic to the 6.5%. It is much more important to get the direction right than to get the precise number right.
So,
Mike, I'm sorry.
I was going to weigh in on the PE ratio, because that's a big component of their analysis. So it's PE ratio and earnings. I think you tie together earnings really well to the economy. I 100% agree with that. So then the question is, what drives PE ratios? And I think about PE, please, whatever, agree, disagree, is a market psychology type of thing. The more exuberant investors are, the higher PE ratios are, and the opposite. So I wouldn't categorize the last decade as one of exuberance. So what drove PE ratios so much higher? I would argue the drop in interest rates. And I've tried to spend a lot of time on my time in front of the boards to talk about the unusual state that interest rates are in. And wasn't by coincidence I showed you the chart for the history of the country. This is the lowest interest rates ever had in our country. Doesn't mean it can't go lower, but a lot of things have happened in the 280 years, whatever the number is. Secondly, over the last decade, what really drove interest rates was quantitative easing across four major central banks. There is not scope to do that level of quantitative easing again. There's not enough bonds for them to buy. So that cannot be repeated. So in my mind, the PE ratios, the expansion of the PE ratio in the example they showed seems like a very low probability event. And then the second part I want to bring in, which I think is the next part of the discussion, is why we want to de-risk the portfolio. And that gets into both the high valuations as well as the consequence of not de-risking. And that gets into that's their page one, I'll let them do it, but it gets into a drawdown. And what we're charged with in this room is returns over a long period of time. And if you limit your drawdown versus what you would not have done otherwise, then you start with a higher level going forward and you compound with a higher number. And to me, that's the critical. I think we've done a reasonable job in trying to explain why markets are expensive. I don't think we've done a reasonable job of explaining the consequence of a drawdown. So that's what I think we're trying to spend some time on, and I'll turn it back over to you guys to walk through that.
Thank you.
Should we cover that
Sure.
page now?
Or did you have additional questions before we move on?
All right, so what I'm about to say makes sense here. I don't know if it'll make sense when it comes out of my face. Is there any benefit, any usefulness in a model that would show a hypothetical portfolio where, okay, we decide that we agree with the heroic version, right? But Rokatan's assumption becomes reality. And what happens to the portfolio in that scenario? And then the opposite of that, whereas we pick your assumption, but the more heroic assumption turns out to be correct. And what the difference would be in actual dollars that we're seeing in the portfolio over a period of time. Is that?
We can do that, and we thought about doing that.
I don't want to give you extra work that's pointless, but I'm just trying, if there's a value to that information, right, for us to see that.
So let me just jump in for one second, because we thought, while we were talking about the slides that we wanted to bring to the board, we thought about doing that. Well, what would happen if 3.4 was right? What would happen if 6 was right? And the reason I argued against doing that is because you have to predict how everything else is going to react. And so I think it gives a false sense of certainty to saying this is what happens if 3.4 results, because then tell me what happens to tell me why that happened and what happens to the fixed income markets. And you can't tell me that, and then I'm just making up a lot of numbers. And so I'm reluctant to do that, because then I'm giving you information you're using to make a decision. And I think that there are too many variables and there's too much uncertainty for me to say, if I'm right and you de-risk, you save $2 billion, because I would have to predict everything else in the portfolio, and I can't do that. But this analysis of drawdowns is much simpler, and it says, why bother reducing risk? Because the reality is we are investors with an 80-year time horizon, maybe longer than that.
Perpetual.
What?
Perpetual.
Perpetual, yes, so perpetual. And we, for that reason, avoid making many tactical decisions, and we recognize that we're steering a huge ship, and we don't want to pretend that we can avoid all of the losses, because we're taking risks to generate returns, and along the way we are going to absolutely experience losses. We can't avoid them. But nonetheless, we do look at this every 3 years for a reason. And we look at this every 3 years to see if there are any opportunities that we have overlooked in the past or have emerged, And whether there are any new and significant risks that have emerged that we want to pay attention to. So having a perpetual time frame isn't the same as saying stay the course and never deviate. But it does say we only want to make deviations when there are significant opportunities or risks. And so the question at hand is this a significant enough risk to make a deviation? Recognizing that we will want to re-risk at some point, right? We don't want to permanently lower risk. We don't want to permanently lower the allocation to U.S. equities necessarily. What we're saying is for the next 3 years until we reconsider this analysis again, or until some huge event causes us to reconsider this analysis, because we could do it anytime the board would like us to. Is there a significant enough risk to take action relative to the current policy target?
Dave, let me take a crack at the answer as well. Directionally, you know you know the answer to what they're saying. So it's all the variables that are going to drive that answer. If you keep the same portfolio and 3.5 comes, you're going to have a bigger drawdown. If you reduce it and the market earns 6, you're going to earn less. So then it gets into risk reward probability. And you know, we don't know what's going to happen. I think we all acknowledge that.
Right.
But given where we are, the probability seems skewed to not repeat what happened in the last decade.
And I think all the consultants would agree with that, but they still think, okay, we're not going to repeat the 13%, but we might have 6%. I mean, to give them their due, it's not that they're assuming anything fantastical. Yeah. They're just assuming a more benign environment and higher earnings growth and higher PE multiples than we're assuming.
You sort of just have to piece the 2 decades together, right? Yeah. So we got 13 for the last decade. If we get 6 for the next decade, that's roughly at 10% for 2 decades. Are you supposed to earn 10% for 2 decades? Probably not. You're probably supposed to earn something closer to 7 or 8. And we don't have the crystal ball, but 10% for 20 years seems like it's on the high side. Again, kind of back to Mike's point about probabilities. Is it part of the distribution of outcomes? Sure. Is it more likely outcome? Probably not.
And if you think back to that Bridgewater chart that I shared with you all, that shows the last 70 years, each decade's return for an index 65-35 portfolio. You know, the last 10 years, and then the next 10 years after that, those were all-time highs. It's history. It doesn't necessarily repeat, but it's something to keep in mind when you're trying to formulate that probability of growth.
Let me just ask this question. So your inflation assumption is what's your inflation assumption?
It's 2.25.
2.25. So your real return is 1.25 for U.S.
That's right. Yeah.
Has it ever been that low over a 10-year period?
Probably in the 70s.
But that's when inflation was in double digits.
Yeah, I mean, if we went back and reran our assumptions in the late 90s, early 2000s, you would get an assumption that was just as draconian, right? When valuations were much higher than they are today. So back to that CAPE chart that was on slide 4, I think it is, right? If you look at valuations in the late 90s, 40, 45 times. If you were to kind of go back and strike a set of assumptions at that time, you would come up with a real return estimate that was quite low.
But his question is realized 10-year returns of 1.25 for the equity market?
I mean, we've had the decade ending 08 was 0 nominal, right? So
with two major drops.
Yeah.
It's interesting to me on the CAPE chart that the drop, the 2002 drop is really in CAPE or in PE is much more severe than the 2008 drop, whereas the 2008 drop in terms of actual stock market valuations was much more severe than 2002, I think. Am I wrong about that?
Yeah, I think that maybe the difference being that the 08 correction was very severe in a short space of time. The 2000, kind of the bursting of that tech bubble did last over really 3 years. So I think if you look kind of point to point, the drawdowns are actually not all that different, but maybe the tech bubble just kind of felt less bad, given that it happened over such an extended period of time.
You had time to adjust to poverty.
The earnings chart is almost the opposite, right? Where the earnings chart, the 2008 drop is much more severe than the 2000 tech bubble drop.
But that wasn't just the tech bubble, that was also WorldCom and Enron and then 9/11.
Telecom tech, right? I get it.
Yeah.
I'm just saying, but you're saying, but it'd be interesting. Whatever. I guess you put these on top of each other, and you're saying that's where you get the total stock market.
Yeah, you have the on page 2. You have the index level. You can sort of, it's a little hard to see, but that gradual 2000 slow grind down to sort of 2003, and then you can see what happened in 08 there. Very sharp, kind of severe correction.
I just ask another question about the chart. On page 4, the PE was higher in 2016 and 2017 than it is today. I mean, maybe that's not up till today, actually, December 31st, but it went down even though returns have.
Yeah. So so you pointing out sort of the methodology. I don't want to say issue because that's overstating it, but what CAPE does is it looks back 10 years on earnings. And so what you're doing as you're getting out towards sort of 17, 18, 19 is you're rolling off some of the very bad earnings that are at the beginning of that time period. So that artificially might be too strong a word, but it lowers the PE even when price doesn't change. So there's the P and the E. The P can actually stay the same. If the earnings piece goes up, which it is by virtue of rolling off some of those bad periods, it's actually pushing down.
It's like a denominator.
Exactly.
Yeah, and I would say the other factor was the corporate tax cut. So that boosted E a lot.
That's right.
And so that brought P's down.
Yep.
So prices went up, but E's went up.
So yeah, rolling off bad E's and adding good E's on the front end.
Yeah.
Okay. One other thing that I'm interested in, like I agree with the point that, if you lower your drawdown, then you're starting from a higher base. That's, clear. On the other hand, there's the question of what you give up if you reduce your equity exposure and equities go up, right? And you guys had, and we talked about it, you guys had a 3.5 earnings expectation in 2016 too.
Yes, we did.
And which obviously,
Has not yet materialized.
we got 7 more years to be right.
Even a broken clock.
and so, right.
Thank you for that, Suzanne.
Yeah.
And, part of me, look, I'm very uncomfortable with the size of the equity reduction that you guys are proposing. But I do agree with taking some approach to de-risking. And, one of the questions that I have is that last time, as I recall, we left the equity exposure more or less the same, but we went to the long-term treasury fixed income as a way of hedging.
Yes.
And part of what I need more understanding of is the only way that we can de-risk the portfolio through equity reductions? Or are there other things that we can do with the fixed income allocation to de-risk the portfolio? You guys are proposing increasing investment grade. Basically, I mean, there's some tweaks in there, but it's more or less taking that amount of U.S. equity you're taking out and sticking into investment grade fixed. Is that the only way to de-risk the portfolio, or what are alternatives where we can keep equity exposure at a higher level, but use the fixed income or perhaps other assets, I don't know, to reduce our risk?
Wait, do you want?
Yeah, I'll take a crack at that. The suggestion we made is based upon correlation. So you're dependent upon that correlation holding to de-risk your portfolio. So one has to be comfortable that correlation is going to hold, which then makes you examine what happened over the past 3 years, they both rallied like crazy. Should we expect that to happen again or not? I think you know my view on that. If you really want to de-risk, you sell the stuff you own. You know, otherwise you're dependent upon a model working on correlation benefits.
There's no way to reliably de-risk because of this whole correlation thing. So you just don't know whether the other asset classes will behave as you want them to as a hedge. The only guaranteed way to de-risk is to hold cash. Yeah, and I'm not trying to be humorous, but yeah,
holding cash is also a large risk. I
but
don't
there's
mean
an opportunity
cash.
cost.
Yeah,
Yes,
exactly.
yes.
Right.
So that's right. Reducing U.S. equity would have created realized opportunity costs if we did that in 2016. And the question you're raising is, are we facing the same issue 2019? And you know, the argument we made in 2016 is the same argument we're making in 2019, but we believe it even more firmly in 2019 because we said things were expensive then. I mean, you'd have to question us if we changed our view, right? Because if things were expensive then, they have to be really expensive now, right, in the U.S. equity market. And we think they are. And the simplest way to view this is we've made a lot of money in the U.S. equity market. Let's take some profits off the table, invest it elsewhere in our diversified portfolio, and re-examine this in 36 months.
I'm sorry, re-examine it when?
In 36 months. I mean, we've
36
taken a
months. I thought you
cadence
said
of every...
6 months.
No, yeah, 36 months.
Can I just throw something else out there? Because I think that maybe this discussion came out of a previous meeting's discussion where I questioned, you know, the total expected return.
Mm-hmm.
And I asked Sam and the consultants, you know, to kind of give us some feedback on how we could meet our 7% bogey. So is there any other tweaking that, you know, you would recommend us looking into that maybe, you know, split the difference on this, or, you know, however we get to a more comfortable place? Because I think the goal is de-risking, but also, you know, trying to be more close to the 7% hurdle.
So we have spent some time on that question, and BAM has provided us with some data. So there are a couple of factors. One is we've assumed in this analysis, as we do in all of these kinds of analyses, broad market returns, which works in the case of U.S. stocks and works generally in bonds, doesn't work very well in private equity. And the reality is, in private markets in general, and the reality is that over the past, particularly 5 years, and maybe even a little longer, BAM has done a much better job in private market investing than the broad private markets. That's particularly true in equity and really true in infrastructure, and also true in real estate. And so we think that we could, with intellectual honesty, tweak the total fund return to reflect the allocations to private markets and the above median returns that you've experienced and that you can reasonably be expected to experience going forward because of skill and manager selection, but add as well as the scale of the investments being able to yield much lower than typical fees. So that can tweak. That should be added to the total portfolio bottom line. We don't want to change any of the assumptions because that gets a little messy, but we can change the total bottom line. And there is certainly room for the board to consider intermediate allocation. So one of the things we could do is come back to the board with a set of portfolio mixes that are bookended by our original recommendation, the current policy target, and what are reasonable intermediate steps between those two bookends. And what would that mean for total portfolio expected return, total portfolio risk, both before the incremental returns are added to them as well as after that. I think that might be an interesting
sounds
next step.
great.
I think
Yeah.
that sounds like a good idea.
Okay.
We appreciate that.
Can I just ask one other question
Of course.
about the switch? One of the ways to read the change from the initial policy recommendation to the new one with the adjusted assumptions is that essentially what you do is you take the high yield and take it, it's currently 5, you take it up to 8, and then the new one is 0. And so essentially what you're doing is you're taking the high yield, or most of it, and putting it into equity.
A little bit into OFI.
Yeah.
A little bit into OFI, right?
Yeah.
And I don't know what OFI's correlation is. High yield is fairly highly correlated with equity. So it struck me as kind of weird that you would have this.
It's actually, I think it's actually hopefully intuitive once you sort of just peel back the layers a little bit, which is high yield. If you think about the companies, they're U.S. companies. They're the same. There's a lot of overlap in many cases with U.S. equity markets,
Right.
hence the high correlation. So if you now have an asset, U.S. equity, which is higher return, the optimizer will say, oh, I'd rather own this higher return asset, which looks and feels a lot like this high yield asset class that I currently own. So it actually makes sense, and I think we have the numbers. If you go back to page 3, you can see that we have high yield at 3.7, and we have U.S. equity at 3.5 in the original assumptions.
Right.
So the optimizer prefers high yield. If you look at the adjusted set, high yield stays at 3.7, but U.S. equity goes to 6.4.
Right.
So the optimizer says, I'd rather own more U.S. equity.
Okay, I mean, I get that mechanically, just sort of intuitively. These gyrations on high yield, like, it go from.
Well, a lot of it's
all the way
basket
up to-
clause. So let me put that in. I think you're right.
But U.S. equity and high yield is mostly non-basket. I think 20% basket, right?
Right, but we have limitations on international, so we have limitations on other places we can put the money. That's a very simplistic way of viewing the basket clause, but the basket clause has a huge impact on how you can reallocate those U.S. equity dollars.
Yeah. Okay.
And I think if we pushed you, Robin, if you were going to change your equity assumption, you would probably get around to changing.
Yes.
High yield would probably be the next thing.
Yes, yeah.
I know it's a direct link with private equity and converts. It's not a direct link with high yield, but it's probably the one that
Absolutely.
should go on.
There's a higher correlation.
Yeah.
So if we were going to really go through every asset class, that is one that would be adjusted. Yeah.
Are you guys going to do new capital markets assumptions for December 31st?
Yes.
Yes.
And when will those be?
We have a draft of them. They should be ready in the next week or so.
Okay. So then we would presumably fold those into this analysis as we.
Yeah,
Direction.
what's the change?
Pretty modest. I mean, if anything, I think U.S. equities probably went down a little bit.
Yeah, 3.5.
No, we'll show you them. I would like to stick with these assumptions because there's so many moving variables that I think to introduce yet another set of assumptions, then we'll have to reconcile that. So we'll be happy to share those with you. I don't think they will make a meaningful
Yeah,
difference.
I don't think there's going to be any outliers
Yeah.
relative to what's here.
Yeah. So just to restate next steps, we will come back to the board, and if there are, obviously this is a big download of stuff. So if you have additional questions that you want us to address, obviously we're more than delighted to address them. But we will go back, rerun the model, and provide you with a range of portfolio mixes for your consideration.
I just have one more question I'd like you to address, probably in this rework. But we talk about capital markets assumptions, projections. What we don't talk about is interest rate projections, which clearly will have a dramatic impact, right?
Yes.
And so I'd be interested in what your projection is of what's going to happen to interest rates and how that has an effect on the asset allocation,
Absolutely.
particularly with fixed income.
That's an important building block in all of the assumptions.
Right. So I haven't seen that anywhere, but maybe I just missed it.
No, we probably haven't provided it, but it's embedded in all of
Okay.
this.
Yeah, it'd be helpful.
We'll make it explicit.
Okay. Thank you.
Thank you. We have a resolution.
Okay. So we have a resolution in support of modernizing New York State Retirement and Social Security Law, Section 177. Whereas the permissible type of investments as well as...
Please skip to the resolve.
That the board supports an amendment to RSSL Section 177 to increase the permissible allocation of foreign equity securities and agrees to convey said support to the appropriate legislative bodies and executive agencies, and be it further resolved that the chair, or in their absence, the executive director, or in their absence, the deputy executive director, is hereby authorized and directed to issue instructions and take any other action as may be necessary to implement this resolution.
Thank you. Do I hear a motion to consider this resolution?
So moved.
Thank you, Mr. Brown. Do I hear a second?
Second?
Thank you, Mrs. Vickers. Does anyone want to discuss it? Any discussion about the resolution?
I just have a question. So this is a resolution that the board is adopting, and then we're going to go through the legislative process to implement it.
Yes.
Right? And I guess with the background information, I mean, this went through, unless it's a variation of it, but this went through the legislative session last year, right?
Yes.
So,
Right, this is the same one that we...
remind me, was this done last year too before the legislative session? Or
Yes,
this-
yes. The teachers passed a resolution supporting the change last year.
as well? Okay.
You know, we'll try again as we go through the asset allocation process. Obviously, it's a very important issue that we.
I just didn't recall this last year, that's all.
Anyone else? Great. All those in favor? Aye. Any opposed? Any abstentions? Okay, motion carries. Resolution carries. Now, normally we go into executive session, but am I correct? There is no executive session today?
I don't think Susan or we have any manager updates.
All right. Then I guess we are done. Is there anything else before the board? Anyone else have anything to discuss?
I just wanted to let you know that on the way out for the trustees, we have the CAFR that we give to you. It's in that box.
Was that sent to the OA? I forgot. Hard copies?
Hard copies, I'll give you one.
Was it, no, was it already sent?
I'm not sure.
No, because today's the first day we have the hard copies. So,
And I think usually you do send it, right?
we do, but
Okay,
this
so
is
I'm
the
not
first
gonna
day we'll
wait.
have it.
I won't like
So you'll wait. You'll look
Okay.
it.
Okay. Do I hear a motion to adjourn?
So moved.
Thank you, Mr. Kanansky. Do I hear a second?
Second.
Thank you, Ms. Vickers. All those in favor of adjourning?
Aye.
Any opposed? All right, we are adjourned. Happy New Year, everyone.
Thank you.